In this video, Jacob and I are discussing our stock picking strategies and how we come up with new investment ideas that could potentially make it into our portfolio. I hope you enjoy.
First topic, which is the thought process for picking stocks. I mean, you kind of touched on it a bit there about being more growth orientated. Have you got any principles like you've got to be top digit growth or anything like that? What's the thinking on your checklist?
So this is my source is, the basis of thinking about it is like, if you're doing what we do, you really want to be beating the index and beating the index by a decent margin. Because if I compounded my money at 11%, even after taxes, you're looking at the S&P's 10. The S&P has done 10 since if you measure it from the 1920s or the 1950s or whatever, it's usually like a 9-10% CAGR. You've obviously got the Nasdaq 100, QQQ ETF, that does even higher. So that's where this sort of like obsession with growth comes from. And as I said, you can make money in other ways, but the whole idea is the revenue growth is the prime engine. If a company hasn't got good long run sustained revenue growth, eventually things are going to dry up, right? And all the best companies, you see this pattern of having incredibly sustained revenue growth for an incredibly long time. That's what Amazon, Netflix, Nvidia, all the best performers of all time, they've had revenue growth over a long period of time. So the whole idea with looking at least 15% is that, if I was looking at a company that had 5% revenue growth, there would have to be a lot of either margin expansion or the valuation multiples would need to increase in order for that price action to go up and return more than 10% a year, thus like beating the indexes. So I actually try to look at revenue growth of more than 20%. I cut that a bit of slack, particularly if the company's larger. So I'm talking like more than 100 billion. So Jacob and we both have large holdings in Alphabet, and I cut that some slack on like the growth rate just because it's such a huge company, and then valuation plays into that as well. Uber's a large holding of mine, that's growing less than 20%, but again, the valuation's cheap and they've got some qualitative catalysts that have not shown up in the numbers. But yeah, if it's a young company, I really like to see that growth. And you look at, when you compare most companies that have done really well over the long term and compare them against the S&P, most of that alpha versus the S&P when they were a smaller company. So I really like to see those smaller companies with more than 20% revenue growth. The idea is they capture the opportunity, they keep growing, they optimize their margins, they maybe get into an index like the Nasdaq 100, and then Wall Street's like, oh, and then you sort of get like a few years of steady price action. So that's really the basis of my process. Smaller cap preferred, but I've got a lot of large caps right now. I think you have to in this industry in this like phase that we're in right now. It's also just important to really see the business care about its customers. That's the bottom line. Like, you can do rent seeking, or you can do all these clever tricks to like try to squeeze money out of people, but eventually you're going to damage your reputation and drive the company into the ground. So you want to find a business that's really making their customers' lives easier, and also the kind of products that you would either say, if it's more of an enterprise product, you want to go to the CEO and be like, hey, this is really helping our department, let's get it in the whole company. Or as a consumer product, think about like Spotify, for example, Netflix, you're telling all your friends about it. You're like, you have to do this. Like, SoFi makes banking in the States so much easier. No more automated clearinghouses. Let's like tell everyone about it and have this, everything's in one app. Great. So that's that. Top management teams, really, really important, because that's the captain of the ship. And just the top business quality, right? Like, the economics have to work, the opportunity has to work. That's basically my point. And if you can get a business that's growing well, also at the right price, you think about a business where if the revenue growth 3x's, which if it's growing at 20% CAGR, it'll be a 3x in about 5 years. Plus, if there's a 3x uplift in valuation, so price to sales goes from 5 to 15. Multiply those two together, then you've got your 9x return. So that's really how you can get multi-bag of stocks, growth companies at the right price. How about you, Jacob? Which one of those do you look at most?
Yeah, I was just going to say on your point there, 100%. I think a lot of people don't appreciate a management team. Honestly, can make or break your investments. So many times I've been in stocks thinking this is 100% going to work out, and then management team will go make a decision, and you're thinking, what they're playing at, and then I don't know, something like overpaying for an acquisition or some sort of expansion internationally, then it ends up eating all your profitability. At the end of the day, these are the people that are running your business, making all the big decisions. So it's important to have a good management team, and that's a key point. I think I like founder-led companies if you can, as well, founders that have still a big stake in the business, because it's also in their best interest as well then for the business to be successful, which is funny enough leads to one stock that interested me was Hims and Hers at the time, because the founder then, Andrew Dunham, he had originally a big stake in the business, and both a stock that we've been interested in, and that what's led me to buy Hims and Hers originally. Yeah, but from a stock point of view, pretty flexible, really. I don't mind buying value stocks, don't mind buying dividend stocks, growth stocks. The only thing with growth stocks is, and I'm not particularly buying growth stocks at the moment, is I don't tend to like buying growth stocks at 52-week highs, just because sometimes the valuation makes me nervous. So I'm a bigger value of growth stocks when they're in a crash, if I can. The only growth stocks that really interested me at the moment are D-Local and New Holdings. They seem to be still okay valuations. I don't know if that's just because of the area that they operate in with the Latin America space at the moment. But yeah, I'm buying more value stocks at the moment. I'll be honest with you, I quite like buying falling knives, and sometimes I can get my hands quite bloody doing that. But as long as I've got the conviction, sometimes I do keep going lower, but as long as I've got the conviction and I'm confident they'll work out, then I do like buying falling knives, and sometimes they can turn out to be pretty good performers. I remember buying Hims and Hers, and that was a $10 stock, and thought that was a decent opportunity, and then it fell down to $6, and I was thinking, right, it's not going any lower than that, and then the market just continued to send it down to $3, and obviously we know that one kind of worked out. And I remember like SoFi as well, that was a $10 stock, and then the market just kept sending that down lower to like $6. But overall, yeah, like a total mixture of stocks, value stocks, growth stocks, dividend stocks.
I mean, that's a good place to be, because I agree. Like, now we're at the point where I don't think we're quite in sort of 2021 levels in terms of expensiveness, but as the market gets more expensive, you do have to be very agile in that regard, because yeah, you can be an expert in volatile growth companies that grow 20%, but of course they'll get hit the hardest when the market falls. So you've obviously got to play that. Interesting points. The one thing I'll say is, like, I'm in a friend's house at the moment, and they built their own house 4 years ago, and I just kind of came up with this analogy with regards to founders, because I've also run an Airbnb, right? And then people can kind of like trash the place. And the Airbnb is like when you have a short-term management team that come in, they've not got any equity in the stock or in the Airbnb because they're just staying there for a few days. And then you've got like a long-term CEO that might be someone that's bought the house and they live in the house and they take great care of it. But the founders, that's like building a house. That's like building your own house, not just your house, but your dream house, where you and your family will want to live for like the rest of time. And you're going to take care of that house like nothing else. And I think that's like a really good analogy. It's like, I've never built a massive company, but I've heard a lot of people describe what it's like on various podcasts. It's just like taking care of a baby, or like, baby's different, but it's when you build your own house, you'll take care of that way more than a house you're staying in short term, or even probably a house that you've bought, because every single brick has been sort of done to your taste and you've spent all that time and energy on it. So founders really, really important.
Yeah, that's a good point there, isn't it? You're going to make sure you don't take the shortcuts when building your own home, aren't you? You're not going to take any shortcuts on hiring things for short-term benefit, are you?